We were just looking at your top 10 as at December 2011, and although obviously it is about stock picking, there is now quite a sectoral bias towards technology and IT. And again, you've chosen the undervalued players in that territory. It's not the likes of an Apple and Google, etc. We're looking at Microsoft, Dell, and Intel. Do you think you're going to see further increases in stocks of that nature?
I hope so, but I don't know. So far, they've done fairly well for us. All three of those stocks have appreciated quite handsomely over the past 12 to 18 months. We still feel they're undervalued. Microsoft significantly undervalued. Intel not as much, and Dell not as much. So I think the upside from those two going forward could potentially be less than that from Microsoft. We think Microsoft is still very much undervalued. So generally, we have found value in those sectors of the market, and this is a truism, it's always the case. We find value in those sectors of the market that most people ignore. And it's by dint of the fact that people are ignoring those sectors that they get cheap. So you'll find us scratching around in those pockets of the market and ignoring those portions or those sectors of the market that most people are attracted to because of good historical results.
Piet, can I ask you about some of the background logistics that must be going on in your investment process? And is it possible for you to chat around the screening process that you have in place? In other words, you're coming up with a selection of stocks, you're regarding them as value stocks, but ultimately you're choosing those from a selection of thousands of potential stocks.
Yes.
So you must be following some sort of screening process to identify that. What is that screening process in simple terms? How many stocks are you looking at? Are you looking at a range of markets? What happens to get to the selection?
I think that's a very good question because of exactly what you mentioned. There's so many stocks out there. How do you narrow down your focus and only look at the things that you really want to look at? Well, for us, it's very simple. As I said earlier, we start with a clean sheet of paper, and we do not pretend to know everything about everything. But we have a circle of competence, which we've built out over the past 10 years, and this circle of competence consists of at this stage, about 150 companies, which we know fairly well, which have quality characteristics. Those sort of characteristics are barriers to entry. Barriers that prohibit or inhibit competition from eroding their own margins or their returns on capital. So these are companies we've identified over time as being of high quality and that we have researched over the past 10 years and that we know fairly well. And we are continuously building out that universe of companies. As I said earlier, it's about, at this stage, between 150 and 200 stocks. And every month, every 6 months, every year, we are adding more companies to that circle of competence that we have. So we pick from that group of stocks. And as we do our work, they might not necessarily be cheap when we do our work, but we understand the economics of the business. We think we understand the intrinsic value. And that intrinsic value is a very stable number, fortunately. Just like the value of your house or the value of the business on the corner of the street down below, those values are stable. What's not stable is the price that the market puts on those companies. So that's a very volatile number. And sometimes we are lucky enough that the market puts quite a low price, a price well below the intrinsic value which we've calculated on those businesses. And that's when we step up to the plate and buy them. And then we tend to hold them for a long time. So it's not a very active process in terms of transaction, but it is a very active process in building out our circle of competence of a universe of good quality business that we would like to invest in. And sometimes the market does offer us the opportunity to invest in those companies.
Piet, can I ask you about the business itself? I see that the fund value is 245 million, but I assume that's only the value of the feeder fund. How large is the fund, and also the whole idea about what are the flows into this fund? Is it large? Is it erratic? Is it stable? How does this work for you as a business?
So the feeder fund is 245 million rand. That feeds into the global fund, which is around $300 million. So the feeder fund is just more than 10% of the value of the fund. overall fund. The flows are at this point fairly stable. We are receiving fairly nice inflows because of the historical returns on the fund. It's come up on a number of investors' radars. They are asking us questions just like you are doing right now, trying to understand our philosophy, trying to understand our process, to see if this is in fact a luck shot or repeatable. So, you know, we're speaking to people and trying to convince them that it is repeatable.
Piet, can I just ask you one final question? What is your experience with regards to the domestic appetite for offshore investing? Obviously, a number of investors went offshore. Some of that has worked. A lot of it hasn't worked. Currently, what do you think people are thinking around offshore investments based in South Africa?
That's fascinating. That's actually fascinating. You know, if you look at where we are today, with the South African market having been one of the best performing markets in the world over the past 10 years, and developed markets having done exceedingly poorly over the past 10 years, we are almost now in a mirror image of where we were 10 years ago. If you cast your mind back 10 years ago, nobody wanted to invest in South Africa. Everybody was trying to take their money offshore. They're paying huge asset swap fees to get their money offshore. And 10 years forward, the returns have been good here and bad offshore. Today, people are hesitant to take their money offshore because they've experienced such good returns locally. Well, we would argue that your risk is highest where your experience has been best. So we think today assets in South Africa are overvalued and assets offshore undervalued. But we're struggling to convince investors that is the right way to go. We think if you fast forward 10 years from today, you'll find that offshore would have done a lot better than South Africa. But yeah, it's not an easy sell. People like to invest where it's comfortable, and right now today, emerging markets generally, and South Africa specifically, is quite comfortable to invest in, interestingly enough. But we think from investment, for prospective investment returns, you need to go offshore.
Piet, good having you on the show. Thanks very much for your time. Piet Viljoen, Portfolio Manager at ReCM.